Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the show, my guest and I will cover every angle of real estate within our show, from interest rates to the economy to what's happening in Washington. Anything that affects our real estate markets will be covered here. I know a lot of people have questions about, whether they should buy now versus later, what they think the implications of the Fed and quantitative easing would mean to the overall housing market, where we see things going in the future. And, these are all things that we cover on our show each and every week. We dissect and break down what's going on with the current events as far as, all of the economic things on the calendar, such as one of the biggest ones that we're waiting for this morning is non-farm payrolls to figure out the employment situation, because this creates huge fluctuations in interest rates up and down, whether these numbers are good or bad. And I think, a lot of people just tend to read the national media, and that's their news outlet, that's their way of getting the news, and it doesn't always break things down the way it should to let you know why interest rates are moving one way or the other, why we're seeing price appreciation, because it's critical to understanding why things are happening so that you can make a better educated, more informed decision. So we're going to dive into a bunch of different things today. We're going to talk about whether the Fed could be in trouble in the future. And joining me on our panel today to discuss the many issues is Louis Camerasano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert, and then cited in the Wall Street Journal, Fox, MSN, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm doing grand, Ryan. How are you today?
I'm doing well, sir. So we've got, I believe right here at 8:30, we're supposed to be getting the non-farm payrolls. It's been a rather tumultuous week back and forth as far as mortgage interest rates are concerned. I believe it was yesterday, the European Central Bank basically came out and announced that they were cutting their key interest rate down 0.25%. And the ECB President Draghi, at his press conference, announced that they may experience a prolonged period of low inflation, which when that came out, mortgage-backed securities rallied. Because low inflation is obviously very good for bonds. Bonds love when there's low inflation, and any hit of inflation would make mortgage interest rates shoot through the roof. So we got that, a temporary boost to interest rates, but then all of a sudden, at 8:30, the U.S. data hit that the third quarter GDP for the United States is actually up, and it came in at 2.8%, which was a much stronger reading than what the consensus was of an estimated 2.0. Now, obviously, there's probably going to be more revisions of this GDP. More likely, I would say that they're going to come in lower than not. But I don't even put too much stock in the GDP numbers anyway, because as you and I discussed time and time again, Louis, that these numbers, I think, can be skewed one way or another, and it's kind of giving us a false sense of what's actually going on. The initial weekly jobless claims had a low number of 336,000, but it was very close to market expectations of 335,000, so that wasn't really a big market mover. And it looks like we've got the non-farm payrolls, which came in at 204,000 versus an estimated of 125,000. So that means that they're going to say that there's almost 100,000 more jobs were created. I guarantee this is going to make interest rates get worse, much worse today. What's your take, Louis, over the last week or so and all the information that we've got? We obviously had another bit of news that mortgage applications have been continued to tumble. I believe it dropped by like another 7%. What's your take on the actual employment situation? Once again, I feel like that they can say that there's jobs being created, but there's all these jobs that are being lost at the same time. What's your overall thought on where we're at right now with the employment situation and how that's going to play out and affect the potential mortgage markets?
Okay, Ryan. Well, what's happening is what always happens is you get conflicting data, which gets people off of the concept that QE is forever, that basically we always need to hear over the last 5 years something that indicates that the economy is on the mend, the Fed has done its job, the road to recovery is full speed ahead. Now, you had the GDP number, and as you mentioned, looks like it's a good number, 2.8%. But a lot of that GDP growth was just to build up an inventory. That's a one-time point. Personal consumption was only up 1.5%. Businesses actually cut down on spending in the quarter. So that GDP number of 2.8, first of all, isn't that strong of a number in the first place. Strip out the inventory, and you've got a 2% number, which is lower than the quarter before. But you have to also remember, whatever GDP growth we got, Ryan, was from quantitative easing.
Right.
So all of a sudden now you take quantitative easing away because you say the economy is doing well. Well, now it's not doing well because no more quantitative easing, or you taper quantitative easing. You see the same thing with the jobs report. You have week after week after week of 330,000 jobs lost, and only 180,000 jobs gained in the non-farm payroll, and they call that improvement. Now, today's number, and we don't have the details behind the numbers, I haven't looked at the report yet, it's up 204,000. Not a bad number, a lot more than they expected, but one has to question what are the quality of those jobs, and does that increase just reflect 7 months of very subpar non-farm payroll growth? And are there a lot of part-time jobs in there? Are there mostly restaurant jobs and so on? So, however, a number like that gets people thinking, oh, the Fed isn't going to taper, the economy is improving, and therefore now interest rates are going to rise, and people are going to be on taper watch for December. Yep. And as we know, Ryan, the whole economy is based on this QE. Look what happened yesterday in the stock market. Twitter goes up. It's back to .com days. Twitter makes no money, has a multi-billion-dollar market cap, goes up 70% in its first day. This entire stock market, everything's going up, but is the economy really reflective of the increase in the stock prices? And that brings us to housing, right? Because in housing, the prices of homes are going up, but you still have 25% of people underwater, which leads to an inventory shortage. You still haven't cleared those foreclosures. They've been held back. So basically, you have the same thing in the real estate markets and the stock market, which is low inventory because in the stock market, the companies buy back their shares to keep the inventory low. And then you've got a lot of money flowing into the system through QE because of low interest rates. So if all that dynamic changes, meaning you take away the cheap money, you start to taper QE, it all goes away. Right. And that's where we really have to be looking. And there was a study that came out by Freddie Mac or Fannie Mae, one of the two, doesn't matter, where they basically said that consumer confidence in buying a home is at its all-time low. Only 65% of people think it's a good time to buy. Well, then why are housing prices going up if a lot of people think it's not a good time to buy? Because, as you and I have discussed, Ryan, the money that's flowing in is Wall Street money, not Main Street money. Yep. And Wall Street lives on QE. Take QE away, and that money doesn't flow into the stock market, doesn't flow into the housing market. So all these good signs, green shoots that we've seen since 2009, recovery summer, every year, wait till next year, GDP growth will pick up. Never happens, but they keep doing QE because it never happens. Yeah. So my question, Ryan, is if now all of a sudden it looks like, oh, we've got GDP growth, we've got good job numbers, okay, then pull the plug on QE and see what happens.
Yeah, that's what the image they're trying to paint, this rosy picture, and when they have these reports that kind of back up their stance, oh, it looks like things could be turning the corner. What has happened for the last 3 or 4 years, Louis? I mean, you and I have discussed for years now, and you know what? I've had a lot of questions from people on the website at Real Estate 360 Live. You guys can check that out. That's where a lot of our previous shows are in case you've missed any of them. But we've got questions from listeners that are, you guys have been talking for quite some time now that, interest rates should be rising, right? That there's no way that they can stay that low for that long. And, the honest truth is that, nobody knows how long interest rates can stay at these levels. And there's such masterful manipulation of interest rates right now by the Fed. I mean, they're the lender of only and last resort. So when they're buying up pretty much almost all of the mortgage-backed securities, they're buying so much treasuries, they're manipulating markets, and then we get these reports. This low interest rate environment could go on for some time. I mean, it's going to take. I believe that there was an article, Lewis and Bloomberg. I want to say it was Bloomberg. I don't want to misquote it, but let me see if I can find it. Yeah, it was Bloomberg, and one of the headlines is, Fed anxiety rises as quantitative easing raises risk of loss with political cost. The whole article basically goes into, since the Fed is increasing their balance sheet by buying all these mortgage-backed securities and treasuries, if interest rates were rise, it would essentially put the Fed out of business because they couldn't afford to pay the interest back, right? Well, let me explain something to everybody. Do you really think that they're going to let that happen? Do you really think that they're going to allow interest rates to rise back up? Do you really think that they're going to start to taper back? I don't think so.
And Ryan, why would interest right now? You were correct. You predicted the 10-year note went from 2.6 to 2.72, and if that mentality continues of great economy, good job numbers, and so on, it'll blow through 3%. And what's the Fed going to do next? They're going to start talking about not tapering. Some other report will come out that the economy really isn't that good. They'll point to the labor participation rate just dropped to an all-time low again with this report. It never ends.
Right. And now we have the ECB president basically saying that they're going to lower their key rate, right? I mean, so they've got all these indicators. They're going to say, well, we're still not where we want to be. That's great. We have non-farm payrolls going up, right? But Bernanke, I can hear him now. He's going to come up there and say, well, we'll keep our eye on this, but we still have to have, we have to have a sustained period of these non-farm payrolls going up and everything. You know what I mean? So, and then
you'll have an adjustment in the numbers. You'll have these numbers don't adequately reflect the government shutdown. They'll be more adequately reflected in the next month's report and so on.
Exactly. So temporarily, so we had the non-farm payrolls report. So mortgage interest rates this morning are going to get worse. I can almost promise that. That's what's going to happen.
Well, they already have.
Yeah, they already have. In the short term, that's what happens, right? But as we have time to digest this, and it's just so funny the way that, Wall Street, they're going to look to the Fed to interpret these reports. They look at everything from the Fed's eye. So the Fed, they're going to say, well, if the Fed sees this, they have to start thinking taper again. That's all Wall Street cares about is when they're going to taper. And you brought up a great point. So all the institutional buying, the big money that's actually buying a lot of real estate right now, because they're able to borrow money at next to nothing, these institutions, not the average day Joe, they've got unlimited capital at this point to continue to push these markets. What would happen if all of a sudden interest rates went from 4.5% to 6%? It would completely shut off that. They would no longer want to buy. Institutions would no longer want to buy basically real estate at all because it wouldn't make sense anymore. They wouldn't be able to get the returns that they need. It would still the real estate market for the average Joe would still stay the same, right? But if whatever pool of people are in it right now, that would shrink, I would imagine, by 50% if interest rates rose up to 6%. So then what we would see is we want to look at GDP numbers and everything else, they would completely tank. I mean, it's so funny how quickly everything could actually turn to the negative. You know what I mean? And we could literally go from what everybody thinks is we're going to go back into some sort of recovery, some great economy. But really, I think that really quickly we could go into a depression era. There's no, because we don't have.
It's not sustainable, Ryan. None of this is sustainable. It's all asset price driven. Higher stock prices, higher real estate prices with no underlying improvement in the assets, meaning the houses aren't worth more. There's just a higher price on them, and the stocks really aren't doing that much better, the companies underlying. They just have higher prices because of QE.
Yeah, and so a lot of the questions that we get from listeners, too, is, okay, so what does that mean? Like I saw one of the listeners said, I saw an article on Forbes that was basically the headline was buy now or pay more later. And it went into the article, basically said that, with mortgage rates creeping up towards 5%, potential home buyers will have some decisions to make moving forward because everything's been prognosticated that interest rates are going to move to 5% and to 5.5% and to 6% in 2014. Now, Louis, you and I have said for years that we thought interest rates would rise, and we've just been, amazed at how this has continued on and continued on and continued on. I'm now at the point where I have to tell people, look, just because they say that interest rates are going to go there in 2014 doesn't mean that that's going to happen. And I don't feel like you have to force somebody into making a decision because there's a fear of those rising rates. If you're not in a position right now to be able to take advantage of the low rates, then you just can't do it. But it doesn't mean that they're just going to disappear. And as you and I talked, Louis, I really don't think that they're just going to disappear because they don't really have a choice but to keep these interest rates low. The four things that it said that buyers should take into consideration in that Forbes article was rates will likely rise soon with 5% interest rates right around the corner. The Federal Reserve will start tapering, causing rates to return to historically normal levels of 6 to 7%. Home values are rising, and the autumn buying season is underrated as you can take advantage of year-end tax breaks. Now, granted, they're partially right because, yes, we could have 5% interest rates, but the likelihood of it happening to me is slim to none because the Federal Reserve will start tapering, which was their second thing. I don't see it happening.
Brian, here is a tip for our listeners. There's two ways interest rates rise. On the perception that the economy is improving,
yep,
or the markets say we need to get a higher rate of interest because we don't trust what the U.S. government's doing in respect of monetary and fiscal policy. The latter is very dangerous. The former, the Fed loves. They like for interest rates to start to ratchet up on some false perception that the economy is getting better, like today's job number. Because
right.
What they can always do is they can talk that back down. That's within their control. They want to keep throwing out these little green shoots to show it's working, and then once the rates start to rise, they can knock them back down by talking no taper. They can knock them back down by saying we need more data. They can always control that game. So rates, as long as the Fed is in control, will stay, as you pointed out, in a tight, low range. The only way they're going to go higher is when the rest of the world wakes up who buys U.S. debt securities and says, wait a minute, you're still not going to taper? You're still going to do QE? It's been 5 years. It's 6 years now. You're spending $85 billion a month. That's when you have to worry about rates rising, is when the Fed loses control. But this nonsense about the economy's improving, so today rates go higher, they'll knock that back down with a negative report. And think of it today. If rates go even higher today than the 2.72 and the 10-year note, Bernanke's already got a speech scheduled for 3:30. Two of the Fed governors are already in some conference today. They can start yakking about how we need to look at the underlying data, and then they start putting doubts into the people's minds again that there isn't a December taper.
Yep. Yeah,
they do not want people to think one way or another definitively there will never be a taper, in which case the whole system collapses because people realize the entire economy is based on an admission by the Fed that they have to do QE.
Yep.
And they also don't want people to think that they're not going to taper. So this whole thing is, as you point out, every single week, Ryan, is based upon what does the Fed do, what does the Fed think, what will the Fed say about all this stuff?
Yeah, and that's what I find so interesting. Every week we really, we dive into these discussions about the Fed, but, it's a Fed-based economy, right?
100%.
That's what we have here. There's nothing normal. Nobody really cares about what's actually going on in the economy. They only care about the Fed's perception of what's going on. And because if people actually cared about what the reality of what's going on is, it wouldn't be a very bright and rosy picture that's painted. Because I don't care what numbers they're throwing out there, Louis. I've told you this numerous times. I can ask people on the street. I talked to general managers of major car dealerships that said that people are they're not even getting their cars repoed anymore. They're just coming and handing in the keys. It's not as a great economy or a recovering economy as some would lead us to believe. And the only thing that's keeping us from really turning, down a path of complete disaster is that we have these low interest rates. And that there is a percentage of people that can take advantage of them. There is still some businesses that can get a little bit of money. You know what I mean? It is still, the middle class, I feel like, is moving to the lower middle. Rich are getting richer, the poor are getting poorer. I don't see that these are positive signs, especially for real estate long term. because anytime you have an extended period of time of low interest rate environment, we all know the way this story ended the last time. The only difference is that the last time they were giving out loans where basically you didn't have to put any of your credentials up. You didn't really have to have any skin in the game. So it allowed for more people to take advantage of things. I don't really see this being any difference other than, you really do have to basically qualify for a loan now. The majority of people that are buying houses now are institutional buyers, cash buyers.
Yep.
They make up a large part of this real estate market, which does help home prices continue to rise. Which, now, granted, that's very good for people that are looking to sell right now because it's helped.
Right.
It's helped you. You know what I mean? It's helped get your equity positions up. And the people that are taking advantage and selling now and able to move into another house, I think that's fantastic. I think it's great when people can actually capitalize, take the funds from one property and then go buy the home of their dreams and lock in a low interest rate if you're able to do that. So
that's what this is all about, Ryan. This is about whoever can take advantage of the low interest rates. It's great. This is an entire gift to what you would call the 1%. If you have low interest rates, you can do carry trade. You can do all sorts of speculation and win if you have access to low interest rate capital. Most people don't have that access.
Yeah, investors and hedge funds, they're willing to take more risks when they have this low interest rate environment.
Well, they have to take risks because they can't park their money and get interest.
Yep. Yeah. Well, so one of the questions that I have, and this is from a listener as well, and I wanted to get your take on it, and I'll kind of give you mine. So, let's just say that somebody is selling their house right now, and because they've gotten the equity position now because interest rates have been low inventory, it's driven the prices up, and they finally sell their house and they make $100,000 and they want to go buy another house. One of the common questions that I get is, do you think that it's better to take a lot of that money and throw it into the next house to be able to get that lower interest rate and a lower payment, or is it better to conserve that cash and maybe have a little bit of a higher interest rate, higher payment, but know that you've got that security of excess reserves in your bank account? This is an interesting question that I get from people, and I have my take on it, but I'm curious as to what you would propose that you might do.
Well, and again, this isn't an investment advice. It's just kind of an analysis of what the situation is. Unfortunately, holding cash is a losing proposition. You may think you may be providing yourself with some security, but if you held cash for the last 5 years, you lost money. Not
right.
Because inflation has run away, it's just because you wouldn't have inflation is still higher than what you would get putting the money in the bank. Now, there's good reasons to have cash for a reserve fund, for a rainy day, you lose your job, unexpected expenses. But if above and beyond that, if you're going to have $100,000, you don't need $100,000 in reserve for that. So let's say you're talking about $40,000 or $50,000 that you consider excess and you consider investable money. Well, it's good to have that as dry powder if you find an investment that you think you can get a good return on. Right. But just holding it in cash doesn't make any sense. Putting it into the home, if it's a better home, and you think that putting that extra money in gets you a better house, then it really depends on what your life quality is and how you use money. But really, the only place you can put excess cash right now and get any money back is in the stock market.
Right. Yeah. Yeah, and the interesting thing is, too, is that a lot of people, and I think the reason why I get this question, to be honest, Louis, a lot of the time, is because they remember back to the last boom and bust cycle, right, where they sold their house, they took the profits, they put them into the next home, and then
it crashed.
Lost 50%. Yeah, and then they lost their money. And, and that's why I always tell people that, hey, when you're buying your primary residence, don't look at it as this is an investment that you're making where you're trying to make money, because that's a losing proposition. I'm a big advocate of understanding that what you're really doing is finding a great place for you and your family to live that you enjoy. You want to stay there for an extended period of time, and you can also take advantage of low interest rate environment. You can lock in your monthly home ownership costs, where you don't have to worry about it changing outside of your insurance and your taxes. But I think that what's happened is that many people don't learn their lesson from what took place before, and they're jumping right back into the same thing. They're thinking, oh, well, interest rates are low, prices are going up. I really try to tell people, I say, look, you have to don't focus on where things are going to go 5 years from now, because unfortunately I don't necessarily like where things are going 5 years from now. But what I do know is that you might not be able to buy a house, period, 5 years from now for the type of house that you're trying to get, because you wouldn't be able to afford it at all. Because even if prices were to drop 50% again and interest rates shot up into the 10% range, you're still not buying that house.
Right.
The affordability factor is the biggest thing here. Not how much money you're going to make, not how much money you're going to lose. My thing is, I tend to try to not don't. When I said keep it as cash flow, what I really meant was just not put it as a down payment on a house and be able to take that money and try to leverage it some other way, right?
Oh, okay, sure. Oh, what you're saying is don't. I thought it was the difference between being able to buy a bigger home and therefore you need a bigger down payment. You're saying the same home, just putting less money down.
Exactly. Same home, just putting less money down, because a lot of people, like, let's just say they have a comfortable payment in mind, right? They have a $2,500 payment. In order to achieve that $2,500 payment, though, they're going to have to put down all of their down payment, right?
Right.
Versus potentially only putting down maybe 50% of that, having a slightly higher mortgage payment, but being able to have some of that cash for maybe some other cash reserves, but then using also some of it to leverage it and make some other investments that would yield some sort of return. That way, you're not necessarily tied up where, once you put that $100,000 or whatever that number is into that home, you have to remember that the only way you're ever getting it out is by refinancing, which at that point then you're at the mercy of where the interest rates are, or you have to sell that property, right?
Right.
So, and this was a big thing back in the last boom and bust cycle, because that's exactly what happened. People kept rolling from house to house to house, and they felt like, well, the equity just had to keep going up, and there was no way that it could stop, and eventually it did. And
that's musical chairs, right?
Yep, and when the lending shut down, it put everybody in situations that they had no money left. They had nowhere to turn. The banks wouldn't give them anything. They had no equity left in their property, and that's where everything came tumbling down. So the only difference is today, like I said, it's very difficult to get a loan. So your situation is really, you're just going to buy that house and then you're going to hold on to it for an extended period of time. Now, if you're an investor, this is a completely different conversation. If you're buying a house for an investment, and whether you're flipping it or buying and holding, you're buying based upon, obviously, cheap money again, right? Because you're able to keep your costs down. I know probably 50 to 60 different real estate investors still, and I'm one of them, so I know this. As interest rates were to rise up, it's going to, eat into my profitability. It's going to make these investments, and then when that happens, we're going to have prices moving backwards. So there's going to be less people that are going to be wanting to take risks with real estate when you have rising rates, because that always means that property values are coming back down, right? So
it also means, Ryan, if fewer people are working, and this just came across the wire, and we alluded to, if fewer people are working, there's fewer people that can buy homes. And while we just had this jobs report number, which I don't quite fully believe, of the 200,000 new jobs created, that's not a lot of jobs when you lose 330 applying for benefits each week. However, 932,000 people left the labor force last month, according to the same report. Now, that gives the Fed perfect ammunition to say, wait a minute, we got to focus on the labor participation rate, not on the unemployment rate, because it's now at an all-time low. So when you have fewer people working, that's fewer people that can buy homes. So you have to take that into consideration where you're considering where home prices might be and into your home buying decisions.
And you know what, Louis? And that's the great part about our show is we read further into the data, right? But what most people do is, like I said, you pick up the newspaper, you go to a web page, you go to Bloomberg, CNN Money, any of those sites, and you just see that raw number right there. And that's what they want. They want people to get that feeling that things are turning the corner.
Not just the raw number, Ryan. A headline. I'll give you an example. Reuters, yesterday. U.S. economy grows at a brisk pace while claims fall. Well, claims fall from what? There's still 300,000 a month, and the brisk pace was based on the GDP number, which we've already broken down as not being that big of a deal.
Yeah. Well,
that's just what they do. They read into the data what they want to read into it at the very highest level. But they don't mention that 932,000 people left the labor force last month. That's an incredible amount of people. That's 1 million people.
Well, when have you
just not going to work?
When have you ever heard like CNBC or any of those business shows where they'll give you that number, but then they don't ever bother to dive into what you just said? You know what I mean? And tell you about actually how many people actually left the labor force. They don't want to tell you that because that's the negative part. They build you up just a little bit.
What do they tell you about interest rates, Ryan? What they generally tell you is interest rates are low. They're at a historic low. They don't tell you why. They think it's just some happy happenstance that, some circumstance where rates are low, so, hey, take advantage of them. No, rates are low because the Fed spends $85 billion a month to keep them low and artificially manipulates them there. They don't tell you that. That's why the rates are low. They make it sound like, well, rates are low because it's good for the economy and it's good for you, so you should take advantage of it. Well, sure, you should take advantage of it, but you should be fully aware of why they're that low and why they might change.
Yeah, I mean, well, this report this morning, so the Fannie Mae coupon, the Fannie Mae 30-year 4% coupon has already lost 63 basis points since this report came out this morning. That's a lot.
And the stock market crashes on this good news, and interest rates go up, which is not good news for housing prices. So they're going to have to reverse all this good news pretty quickly by saying things aren't that good, and then the markets will go back up.
Absolutely.
It's a reverse. Good news is bad news, and bad news is good news because it all depends on how the Fed interprets it. And bad news is good news because it means the Fed is going to have to come to the rescue and spend $85 billion or $100 billion or whatever it's going to be to put the economy back on track, which they haven't been able to do in 5 years.
Yeah, and if you actually went back all the way to the beginning of this year and you just kind of looked at mortgage interest rates and the ebbs and flows of them, there's, a lot of charts like these Japanese candlestick charts that will show you, where bonds were. And, the funny thing is that every time that they started to get, pretty bad, I believe the Fed came out and said something, and
of course.
they reversed course, which back when that would never happen. What would actually have to happen is until there was another report that showed otherwise, they would continue to get worse. But they know that they can't allow for these huge spikes. And anytime there's a huge spike in interest rates, right behind it, almost like clockwork, like you said, Louis, Bernanke will come out and interpret the report a little bit differently. And then
let's see what he says later this afternoon. He'll say something about a positive sign in employment. We've got a ways to go. And remember, Yellen, her big thing is fixing employment. She's going to need to take a wait-and-see approach because while the Fed is on record as saying they think that they have helped the economy and they think they've helped the housing recovery, but where they have failed is they have not been able to complete their dual mandate of full employment, and that's where Yellen wants to focus, and she wants to use monetary policy to do that. What does that mean? The only thing monetary policy can do is nothing, but if she wants to try, she has to increase QE.
Right.
So she'll say this is a good sign, but we need more data, but the labor participation rate is troubling. Something like that you'll get out of Bernanke today, which will make people think, oh, okay, so it's not sure that they're going to taper. Because if you look at the headline numbers, if you were already in taper mind mode, that they were going to taper QE, then you get 2.8% GDP growth, and you get double the anticipated amount of jobs, you're thinking, it's a sure thing. They're going to taper. Well, once taper is in people's minds as a sure thing, interest rates spike and everything comes down. So if that's what happens, by the time Bernanke speaks this afternoon, rates are going much higher.
Yep.
He's going to start talking it down.
Yep.
He's not just going to say happy days are here again and it'll allow us to taper.
Well,
no way.
He has to have learned from his big slip. Remember the big slip that he had?
That's what ended it all in May. That's when the rates spiked.
That's when they spiked. And now, like, let's just say, we've lost 60 to 90 basis points this morning, and then he comes out behind it and says, guess what, everybody? We are moving in the right direction. It looks like the taper's right coming around the corner, beginning of January, early February. The mortgage markets would melt. They would completely melt down.
And the stock market would lose 700 points within 10 seconds of him saying that.
Yeah. I mean, so what do you mean, no more cheap money? Oh, we can't do that. We can't do that. So,
but if it really was true and he meant it and there was validity behind it, it would be good news.
Correct.
Hey, we don't need QE anymore.
Yeah.
The experiment worked. The economy's on the right track. That should cause the stock market to go up because it would mean that the underlying values of the companies would be improving because we'd have better employment. We'd have more jobs being created, more goods and services being created. You'd have real GDP growth, real job growth, a real economy without the need for for QE. That'd be cause for celebration. That's an absolute falsehood.
Right. Or
the entire wealth creation is based on QE.
The word real and the Fed should not be used in the same sense. You know, they just shouldn't be. They don't go together at all. Yeah, and so it's going to be interesting. I mean, I think that we should, we'll definitely pay attention to what he says this afternoon. This will be a good topic for our next show as well, because it's almost like, we shouldn't be able to be this good at mind reading what's going to happen next. But the fact of the matter is that they don't have really any other bullets in the chamber of their gun for solutions, other than to continue more of the same. Correct?
They have two things, Ryan. Their ability to print money and their ability to say they're not going to print money. Those are the two things they do. So if they come out and they say, okay, well, we're not going to taper in September, someone or 10 of them come out the next day and say, but we might do it in October. And then all of a sudden the perception changes that, okay, the Fed's not going to just keep printing money. And then they print money in October and they say it's too early, we really don't know the impact of the government shutdown, so we better not taper. Now, data comes out, looks like they're going to taper because it's all positive data. They'll come out in full force in the next 24 hours and talk about, while they remain confident of the economic recovery, they are still taking a wait-and-see approach as to whether, this will be sustained over the coming months. And people go, okay, so then the interest rates will start to tip down again.
Right. Well,
it's nuts. And then something will come up. There's always something. We mentioned it. It's employment. It's the economy. It's the housing market. We don't have enough inflation. Always some nonsense about why, some excuse, they have to continue bailing out the banks with low interest rates and bailing out the U.S. government. And in a sense, in a way, what's not encouraging, Ryan, is the more they add this stuff to their balance sheet, the more the Fed is in trouble. Because what are they going to do with it all?
Yeah. I mean, I have not any clue what they plan on doing with it. And, the whole wait-and-see approach, I mean, how long have they been...
They've been waiting and seeing for 5 years.
Yeah, and what have they come to the conclusion that it's actually benefited anybody other than institutions and banks? I mean, because they're really...
it's funny. It's the trickle-down... They accuse the Republicans with the low taxes and so on as having a trickle-down economy. It really doesn't reach the poor. It doesn't reach the lower class. This is worse.
Right.
This isn't even democratically voted on where people vote for lower taxes and maybe benefits get cut and it doesn't reach the poor. Here, the money just goes directly to the top.
Exactly.
They print the money and they hand it out to the banks and whoever else is associated with the banks who has access to low interest rates, and they get to speculate. That's why, if you look at the art market and it's not just, the real estate prices have gone up. What have really gone up are homes in the Hamptons, homes in Mayfair, London, homes in Singapore, Hong Kong, Paris, the top-notch areas. They've more than doubled in the last couple of years.
Yep.
San Francisco, all the areas where the rich aggregate, all of their toys are far more expensive now.
Yep.
The art market has gone nuts. The luxury housing has gone nuts. And they're able to pay it.
Yeah, and that's just a byproduct of cheap capital, right?
And because cheap capital isn't cheap for everybody. By the time you and I get it, and it trickles down to the bottom, that's where you get inflated, the impacts of inflation, and your dollar buys less. Whereas in the beginning, the people who get it first get the full 100% value of it, and they go out and they spend it.
Yeah, and
they buy more assets. So even though when assets prices collapse, other than stocks, they still have assets like real estate and gold and art and so on. They still have those assets. They may have overpaid for them, but at least they have them. And you and I will have dollars that'll be worth less.
Yeah, won't be worth much. I mean, every day that this continues, every day that this wait-and-see approach continues, and they continue to print more. And I'm already, like I said, I'm already on record as saying once Yellen gets in, and they start to digest more of the economic reports and information that they have, that she's going to realize that, wow, we can't not only stop, and taper, we've got to actually add more.
Right. What they might do, Ryan, though, what they might do to set the table for Yellen to become the cranker of the printing press, and it might just be for Bernanke's legacy. Let's say they decide not to put the brakes on and to say that they really think that the economy is doing really well and we've kind of turned the corner. This job report shows it. Next month shows the same thing. And Bernanke, as a parting gift, says, hey, I said I'd taper by the end of the year. He goes ahead and tapers, and all hell breaks loose. Well, that gives Yellen the opportunity to step in and say, okay, I got to crank this thing up. That might give them a shred of credibility, but would also expose them. So I always, I've always had a little different view than you, Ron, but you've always been correct. I've been wrong. That the Fed may always try something to gain a little credibility and actually go ahead and maybe throw in a little taper just for size.
Yeah. Yeah.
I don't 100% believe that, but I think there's a chance they would do that, but not because I think it would be a step in a long line of tapering. It's just that it would set the stage for future increases in QE.
See, I just believe that even the smallest of taper, Lewis, now, granted, maybe if the taper was more on treasuries and not mortgage-backed securities, right?
Yes.
Then that's a different story, because then they didn't really change anything as far as their purchases of mortgage-backed securities, which actually directly affect mortgage interest rates. But if they pulled back on just treasuries, yeah, that might actually, give some sort of sign. But to me, that's still tipping their hat that, guess what, treasuries first, then come mortgage-backed securities. The rates would naturally rise because they know that it's coming at that point. You know what I mean?
Right, but they can reverse that, and they can reverse that and then print more to kind of bring it back down.
Yeah. While I feel like they should be doing all these things, I just think that they're not even smart enough to do that. I think that it's going to – I really don't. I mean, I think that they're going to continue this. This is going to go on for a long time. Like I said, I don't know when it's going to –
They just want people to think they might do it, but they'll never do it.
They'll never do it. No, I mean, when we start seeing non-farm payrolls at, 200,000 every single time above where the expectations are, and we see not the unemployment rate dropping down, but really dropping down, and we're taking into consideration the real numbers, not just the ones that they want to put out there to the media, then maybe we can start to talk paper, but not until then. I mean, that's the unfortunate realization that I've come to.
But where does it lead, though? And you and I have been talking about this. We have said that the more they do this, the more inevitable the crash is and the worse it's going to be. But when is that happening?
Well, not on Obama's dime. I've already come to that conclusion. It's not going to happen while he's in office. So I think that he's going to leave this disaster for somebody else. So I'm going to say 2 or 3 years. That's what I'm projecting out. Because they'll try anything. They'll create another program if they have to. They'll do anything to not take away from his presidency. I'm convinced of that by now, because otherwise, that's why I said this whole charade with the Fed, and then he's getting to pick his person. He's getting to pick Yellen, and Yellen's going to go in and do whatever they've talked about doing, which is exactly what I think. So they're going to continue to keep interest rates low, if not try to push them down a little bit further.
So you're saying by design, the Fed will not do anything. However, there could be international events that could displace their plans.
Absolutely. That's the only thing.
But that's the only way it'll happen. You're saying the Fed will not self-inflict a wound.
No.
They will just continue to print and try to keep interest rates as low as they can while trying to pretend and stave off the international event by saying, well, we're going to stop this soon, really. We mean it.
Absolutely.
Now, this time.
Absolutely.
And that's kind of what they've been doing. They have not, if you think about it, nothing has changed. That's what they've done for 5 years.
Right.
They've always said the economy is improving. No, it isn't. And then they've done QE, and then they said, well, we're going to stop it. Then they stop, and then they start it again. And if you remember, this taper talk is kind of ridiculous, because didn't they taper QE1, QE2, and QE3 and then restart them all?
Right. Yeah.
I mean, they can taper all they want, but it's not like it's going to go away. And especially because you have to take into account, Ryan, if Japan is on a printing spree and Europe is just driving rates down to nothing, the United States can't afford not to keep pace. And if they think they can keep interest rates low just by saying they're low without QE, that's a fantasy. You saw what happened when they said they were going to do that. They're still saying it. When QE ends, they'll keep interest rates low. You're sure they will. They'll put a low rate. That doesn't mean the market will accept it.
Well, and and not to mention, you talk about international events. Yeah, I like if Bernanke were to today to say, hey, looks like we're going to taper, I think right behind that we have another Syria event take place. Okay? I mean, honestly, that's what it seems to be going on here. I mean, it's literally like that. And then all of a sudden, all of our focus completely comes off the economy again. It gets shifted overseas, and everybody's worried about that. And then as that happens, mortgage interest rates start to come back down again.
Ryan, you remind me of the Peanuts cartoon where, what was it, Linus or not Snoopy, Linus or Charlie Brown is going to kick the football.
Yeah.
And Lucy's going to hold it for him. And what does she always do? She pulls the ball away at the last minute, and he tries to kick it, and he falls on his face.
Absolutely.
Bernanke is Lucy. He's going to pull the ball away at the very moment where you think he's going to allow someone to kick it.
I agree with that, and and I wish I was wrong, but I just I don't know.
But even you and I start to believe it. We start to think, yeah, well, okay, that's a good number, so maybe they'll taper. Right? In September, when I realized it was 100% crock, was after the September no taper. They said it was close. They could have done it. And if the data shows better, in 2 weeks it was going to all of a sudden magically better. They would taper in October. That's when I realized it's 100% con game.
Oh, yeah. Yeah.
I mean, when you come out the next day and say, well, we almost did it. Well, we'll do it in October. And then you don't do it in October.
I know, and this is it's just gonna, and they're gonna look at data, like I said, because of the whole government shutdown. They're gonna say that we don't have an accurate representation of what's actually going on yet.
Well, I'll tell you, that data that they came out with, I don't believe it for 1 second.
I don't either.
There's either a lot. I haven't looked at the numbers. These part-time jobs in there. Not when 1 million people leave the labor force. Well, I'll tell you what. Maybe so many people, were in jobs that were so bad, right? Jobs that they're better off taking benefits. They left them, horrible jobs, and they had to be replaced. So you've got 1 million people leave and 200,000 people take those lousy jobs.
True.
Congratulations. That's not job growth.
No. And like I said, I mean, and you don't need these reports to be able to actually figure out what's going on in the economy.
Well, first of all, Ryan, if the government shutdown caused this, that's a good thing. They should just keep the government shut down and we'll get job growth.
Yeah, it makes a whole lot of sense, doesn't it? That people,
because aren't they worried that
the
shutting of the Washington Monument, that was going to really cause the employment to shut down? Well, it didn't. Looks like all of a sudden you want to believe the government's numbers, 200,000 people got jobs.
Well, if you remember, I told you that I actually had played golf one day, and I showed up to the golf course when the government was shut down, and they had their highest grossing month that they've ever had because of it, right?
There you go, sure.
There were some businesses that benefit from the shutdown.
That shutdown is a farce. They're going to use it they're going to dismiss it if it was good, things happen because of it, and they will use it for the next 20 years as to why you never want to let the government shut down, because look at the economic disaster that came about.
Well, the irony of all this, Lewis, is that we're going to deal with this all over again come January and February.
Absolutely.
So, I mean, we get to talk about this all over again for the next.
Well, there's another reason not to taper. In December, they may say no significant inroads have been made in solving the budget deficit. While the economy is improving, it's fiscal policy we're concerned about, and therefore it wouldn't be appropriate to taper at this time because of the uncertainties of the January budget debate outcome. There you go.
Absolutely.
So while the economy is improving and we did our job, it's those pesky congressmen. They don't know how to do theirs, so we have to save the day, and we're going to have to reluctantly not taper.
Well, I think what you should do, Lewis, is go ahead and type that blog post up and put a future date on it and see how close you really are, because that sounded pretty spot on there, buddy.
Ryan, if you go back to the Small Goal blog, and what I did the other day was, and it was kind of self-serving, but I date-stamped the housing recovery chronology since April, basically saying there wasn't one, and citing all the reasons, back since April, why the housing recovery was solely based on QE. And once they started talking about not doing QE, the whole thing unraveled.
Yep.
And you can see it. And during that time period, you still have people saying, oh, higher interest rates, that doesn't matter, because they're historically low. Of course it matters. And, of course, the job market matters. And the myth of, these 18 and 25-year-olds all of a sudden shedding their debt, marching out of their parents' basements, with jobs and money in hand to buy houses, and somehow that's going to boost the housing recovery, that's stupidity too.
Yep.
But that's what you heard during the last 6 months. Housing recovery was intractable, had nothing to do with interest rates. Besides, here's the other one. If interest rates are rising, it's a good sign. Why? Because the economy is improving. No, it's because people are worried that the Fed's going to stop throwing money at the system.
Absolutely. And I mean, for us to think that, we have to have a complete brilliant housing market in order for the economy to be thriving. I mean, we've
the other way around.
That's not what we want. I mean,
housing doesn't create jobs other than, and this isn't a cut on realtors. Sure, they make money. There's a service, but they don't drive the economy. People moving in the houses doesn't drive the economy. It doesn't create more goods. Doesn't create more services. It just means somebody's house price went up and a few more commissions were made.
Yeah.
It's not because if that were the case, they could just do a government mandate that people have to move every 5 years.
Yeah, and the economy would be on fire, right? If that happens.
Because if you have to move and you're forced to move, then there's moving expenses but that's ridiculous. An economy is based on more goods and services being produced, and therefore consumers have more to buy, and because they're producing those goods and services, they have more money to buy stuff. Not because they're moving in and out of houses.
Well, the interesting thing is, I talked to a client last week, and then, they were like, well, I've come to the conclusion with interest rates where they're at, I mean, that I'm paying ridiculous rent prices right now that I can buy, but the problem is when she went to look at what she could buy in the same area, regardless of what the interest rates are, she can't afford it. So, rents are going to continue to rise through this whole period of time too, which has been, it's been happening for some time now. But I think, like I said, a big component of this is that when you're buying that primary residence, you're buying that house to live in, don't worry about where the value of that home's going because ultimately you really have no control over it. And you could say, well, I need to buy in this neighborhood because this one's going to hold its value better than this other one. You don't know. Nobody knows.
Well, that's true. You don't know.
Everybody, you can try to guess. You can gamble and say, well, I think that this neighborhood is more exclusive, and that way, it's going to hold its value. But guess what happened during the last bust cycle? I mean, almost all the neighborhoods lost their value. They're the same.
Look at up-and-coming neighborhoods happen all the time. In New York City, you had the Upper West Side, used to be half a war zone, almost become very desirable.
Yeah.
Now, did the East Side lose as a result? A little bit, because there's now competition for other exclusive areas in New York City. It used to be in the 70s. The Upper East Side was probably the only place where rich people lived. But then, basically, everyone who lives in Manhattan now has to be rich. There's so many areas that have been up and coming and are now full of people who are on Wall Street making a lot of money and are paying, $1 million, $2 million for small apartments. Yeah, not just Upper East Side stuff.
Exactly. And, unless you're an investor, don't worry about, what your equity position is going to be in the next year or two. Because, if you've got a low interest rate, you're going to pay, a lot less interest over a period of time than somebody else in the future might pay. If you're able to take advantage of getting a loan, and like I always tell people, if you're unsure if you can even obtain a loan right now, the best thing that you can do is to reach out to a professional that can evaluate where you stand right now today. I mean, I'm in shock, but over the last 6 months or so, we've actually helped a lot of people that thought that they couldn't buy just because of their credit scores. They thought that they needed a larger down payment. There actually are still some programs out there from credit unions. You can still, believe it or not, get 100% financing up to $625,000, okay? Many people don't even know that. That's a unique program. You can't own another home, so there are some caveats to it, obviously. But there are definitely programs out there that can help people, even people that don't have large down payments. So, don't just bury your head in the sand and assume that you can't do it. At least reach out, find out what your options are. You might find that you can actually do something right now versus having to wait years from now. And if you read too much of what's in the media, you'll probably start to get turned off about the whole home buying process. Granted, I'm in it every day, and it frustrates the heck out of me sometimes especially with all the government regulations and stuff that's going to be carried forward into January, where there's going to be a lot of changes with the qualified residential mortgage rule that's coming out. That's going to change a lot of things. We'll probably jump into that on a future call as well. I did want to give a credit tip this week, Louis. I mean, we typically try to do that at least once a week. This is, I most of the time refer my clients to the credit pros. These are credit professionals and attorney-based firms that can help people get their credit scores up in order to put you in a position to potentially buy a property. And one of the topics that they actually spoke about with them last week was, is it better to pay off your balances on your credit cards or spread it around to lower them down on all of them? And really the answer to this is quite interesting, because neither is actually really good for your scores, because you have one maxed out credit card, that's bad, but also having, your a bunch of limits on a bunch of cards that are all maxed out is even worse. And you get negative scores for too many accounts with balances, but then you also get a negative score for too many revolving accounts with balances. So even if if you have 5 cards and you've got all of them underneath the balances, you're still getting hit negatively because you got too many revolving accounts. So what they actually tell you that the best thing to do is to pay as many of your credit cards to zero as possible so that you don't have balances on them. And be sure to keep all of your credit cards under the limit at the same time. Now, as far as the limit, so let's say you have a $1,000 limit, you probably want to keep that to about 30%. So your proportion of balance with the high credit limits in line as well. So if you had 5 cards and you really want your credit score to jump up, then the smartest thing to do is to pay 4 of them to zero if you can, if they were all $1,000 max, and keep one of them at $300. That would significantly drive up your score. I bet it would probably, I don't know the exact numbers, but probably, 50, 60, 70 points. And that could be in a matter of a month, Louis.
Right.
Now, why is that important? Because that could be the difference between a 680 score and a 740. All right? Now, that difference in credit score could mean a quarter, a 3/8 in interest rate. It can be the difference between you getting a 100% loan and having to put 5 or 10% down. Just that small little difference there between 680 and 740 means the world, especially the banks. They want the cream of the crop. And just because you're not cream of the crop right now doesn't mean you can't get there in a month or two. But you have to be proactive about this process. There's too many people that don't, and they don't want to let a professional handle it.
That's a good point, Ryan. People can improve their credit and become that cream of the crop.
Absolutely. People don't just get that way or aren't just anointed cream of the crop. They have to work at that to become
right.
it. And it's not that difficult to do that, guys. I mean, and like I said, all you have to do, if you're in a situation right now and you want to get some professionals to look at your credit and get it where it needs to be, call me. I'll put you in touch with them. They're great. Like I said, they can't guarantee the timeline, but I promise if you work with them and you follow their model, you will be in a position to probably buy a house within a year or so, if not less. 703-596-0011 or 800 number is 877-245-2030. We're coming up on the end of the show. Louis, I want to thank you for coming on. Let our listeners know about your blog and where they can find you.
Thanks, Ryan. Thanks, everyone. Smallgold.com, SMAULGLD.com is a place to go to get economic analysis, real estate analysis, and information on gold and silver. So you go to smallgold.com. There's an article up there every couple of days. Look forward to seeing you there. Thanks.
Thanks, Louis. Appreciate it. Guys,
Thanks,
if
Ryan.
you have any other questions for me, 877-245-2030. You can catch all of our shows on the website at realestate360live.com. That's realestate360live.com. Until next time.